Hello, money and banking students. Dr. Z here, and just want to present a little overview of Chapter 12. Our subject in Chapter 12 is financial derivatives. Our objectives are to define financial derivatives and explain the economic functions that they fulfill. We will define and describe the four major types of derivatives. Those are forwards, futures, options, and swaps. And we'll explain the economic functions of hedging and speculating. So what are financial derivatives and what economic needs do they fulfill? Financial derivatives are a special type of financial instrument. Financial instrument like a stock or a bond or a certificate of deposit. Derivatives are instruments just like those. Their prices are derived from the price or performance of an underlying asset. And the prices of derivatives are based on supply and demand. The economic functions of derivatives are basically to hedge or to speculate. So if I am a producer and I want to guarantee my price of an input cost, that would be using a derivative to hedge. If I'm on the other side and I think that prices are going to go in the opposite direction, I can use a derivative to speculate and make money on the opposite side of the trade. Derivatives are neither good nor bad. They're a financial instrument. Sometimes the media and the press have made out derivatives to be evil or to be bad, or to be the cause of the financial crisis, but they're just a financial instrument, and how they're used can determine their goodness or their badness. Derivatives are tools. If I'm hedging, I'm trying to limit my losses, or if I'm speculating, I'm trying to multiply my gains. In Section 2 of the textbook, we look at forward contracts and future contracts. Forward contract is where a buyer and a seller agree today on a price of an asset to be purchased and delivered in the future. So it helps to alleviate the fears of volatile prices for both the buyer and the seller. Three problems with forward contracts. One, it was often difficult for parties to find each other. These contracts were private instruments. They are not traded on exchanges. So finding a willing party to be on the other side of the contract was sometimes a challenge. They're illiquid because they're not traded on an exchange. So again, finding willing buyers and sellers is difficult. And because they're not traded on an exchange, there usually were incentives for one party, the losing party, to break the agreement. So because forward contracts had issues, future contracts were developed to help alleviate the problems of forward contracts. So future contracts are an efficient way to link buyers and sellers through the exchanges. The Chicago Board of Exchange, Chicago Board of Trade are a couple of examples of exchanges that handle futures contracts. In fact, in the past, I've taken our money and banking class to the Chicago Board of Exchange to watch the exchange of buyers and sellers in the pits. The exchanges have well-defined standards, so the future contracts are much better enforced between the different parties. Futures contracts enable businesses to lock in a price, just like forward contracts did. But because exchanges require both parties to have margin accounts, money basically in an account, that helps mitigate the breakdown in contracts and kind of discourages parties from reneging on their agreements. So basically, a supplier agrees to supply at a contract price, and a buyer agrees to purchase at a contract price. In the final section of the text, we look at options and swaps. Options give the owners the option to purchase, that's known as a call, or sell, which is known as a put, an underlying asset at a predetermined strike price on or before the expiration date. It should be noted that a European option, you can only execute it on the expiration date, whereas an American style, you can execute it on or before the expiration date. Most options are tied to stocks, but you can have options on other assets as well, like the option to buy a piece of real estate. When an option is purchased, there is a premium that basically is based on the option type, the strike price, expiration date, interest rates, and volatility of the underlying asset. So let's take a look at how options work. Let's say I'm interested in buying Amazon. Well, close of business on Friday, Amazon was trading at a little over $1,900 a share. So if I wanted to buy 100 shares of Amazon, I would need $190,000 to do so. $1,900 times 100 shares. Options give me the right but not the obligation to buy 100 shares at the predetermined price. So let's say that I wanted to look at options for Amazon, and I want to go out, I'm going to go out to June of 2021. So that would give me between now and June 18th of 2021 to exercise the option. And let's say I think Amazon's going to go up, and it's going to go exponentially up. So here at $2,500 strike price, I can buy an option for $95.65 per share that gives me the right but not the obligation to buy 100 shares of Amazon at $2,500 before June 18th of 2021. Now, this underlying option, its price goes up and down with the price of Amazon. So one of the ways I could make money, as Amazon stock price goes up, this option price is going to go up. And so I could choose to sell the option price anytime between now and June 18th of 2021 and make the difference between $95.65 and whatever it would go to when I sell it. So, and if I chose to exercise this, if I held this and I wanted to actually buy Amazon at $2,500, I would have only paid $9,565 for that particular right to buy Amazon at $2,500 a share. So the Amazon example I just shared would be an example where I'm buying a call option because I think the underlying asset's going to go up and I'm going to make money on the price movement. Another way that I could use options is to protect my downside risk. I could sell a put option, which basically would give me the right to sell my stock at a price. And so let's say that I had a stock that I bought it at $50 a share. It's gone up to $100, and I want to protect my downside risk. I might buy a put option at $75, and if it got below $75, I would be able to sell it at that $75 price and not, lose all the profit that I had made between 50 and 75. So that's how puts are used. A swap is where we exchange one asset for another, and that can be combined to form a derivative called a swaption. One type of swap is an interest rate swap that helps buffer banks or even clients against interest rate risk. At this time, please pause the PowerPoint and go into Moodle and watch What is a Swap? A credit default swap is an unregulated form of insurance against default of a bond issuer, and that could be a country, it could be a corporation. At this time, pause my PowerPoint and go into Moodle and watch Credit Default Swaps. What are they, and should investors be worried about them? Okay, that's a brief overview of Chapter 12. Make sure you read the chapter, watch the videos, and do everything that's assigned for this week. Take care.